In this video, we are going to be doing a quick and brief recap of the information covered in parts 1 through 10 of this series. I'm not going to be going over each item and things in this list because I won't be getting into too much detail of each, and so you can pause the video to give yourself time to look at the lists if you so choose. This video serves much more as a summary, and if you want to go into more depth in a specific part, check out the separate videos in parts 1 through 10. So we started off with explaining what income is. The definition of income that we have here is all of the taxpayer's income, both taxable and non-taxable, and it can be defined as any increase in wealth. We also have gross income, which is all income from whatever source derived except as otherwise provided. And we said that unrealized gains do not count. So the major difference between these two when it comes to tax is that income can include sources of wealth that is not taxable, but gross income will only include the portion of your income that is taxable and will exclude the portion that is non-taxable. When it comes to tax, your gross income is the more important figure of the two. Now this except as otherwise provided refers to exclusions. Exclusions are sources of taxable income that can be excluded from your gross income. These are things that the IRS gives you a pass on from being taxed. Maybe you have 10K of income from one source, but it can be classified as an exclusion. This means that it is excluded from your gross income and is not taxable. If something is excluded from your gross income, referred to as exclusions, then that means it is not taxable. So here I have listed examples of things that are included in your gross income. These are things that are taxable. And below I have examples of exclusions. These are things that are not included in your gross income and therefore are not taxable. Next up, we have deductions for AGI. These are deductions which are items you can use to reduce your taxable income and how much taxes you owe that more specifically serve to reduce your adjusted gross income, which when it comes to taxes is actually much more important than your gross income. We also mentioned that unless specified, such as medical expenses, personal expenses are not deductible. This means your day-to-day grocery shopping, your daily commute to work as an employee, you can't deduct the amount you pay on gas, or even if you sell your personal home at a loss, that is not deductible. Next up, we have itemized deductions. Now, itemized deductions are like deductions for AGI, but they differ in two main ways. They do not reduce your adjusted gross income, and unlike deductions for AGI, not everyone is eligible to take an itemized deduction, what's known as a deduction from AGI. Only those who choose to itemize their deduction can take this deduction. For those who take a standard deduction, these following deductions right here, listed right here, are not deductions that you can take. And of course, we also went over common expenses that are not deductions. Notice things like personal living expenses here are not included as mentioned before, and so are the losses on the sale of personal use property is also one of them. Now finally we have reached the taxable income formula, which is found right here. We talked about the standard and itemized deductions and how they're different. Remember, taxpayers have the choice each year when they file their federal income taxes if they want to take the standard or itemized deduction. The standard deduction is just a flat number that only changes between filing status, something we'll go over in a future video, and year by year to adjust for inflation, It is a fixed amount of money that the IRS allows you to use if you choose it over itemized deduction to deduct from your taxable income. Now on the flip side, you can choose the itemized deduction, where you specifically calculate what your itemized deductions are based upon your expenses, and this will of course vary, unlike the standard deduction. Take a look at Schedule A, or Part 8 of my series for itemized deductions, and also briefly we saw it earlier, the list in this video. One last thing I want to conclude on is about gross income versus taxable income, which I went over in Part 4. We can see from this formula alone that the two are different. Now I know here it says gross income is income minus exclusions, and that's true. But in other accounting branches, when we think of income, we think revenue minus expenses, but that's not how income is in the tax world for reaching taxable income. Here, income is basically synonymous with revenue, and we can just forget about subtracting the expenses. Just think about income as revenue, whatever money you make from whatever source derived. Now subtract exclusions, which we also briefly talked about in this video, and that's gross income. But gross income isn't your taxable income. Taxable income is the amount of income that you pay taxes on. Gross income is just a figure you need to calculate to arrive at your taxable income, so they are not the same thing. But just because your gross income is 50K does not mean you'll be taxed on 50K. If your taxable income is 50K, on the other hand, yes, you'll be taxed on 50K. But then from that 50K gross income, you get to take deductions, including the deductions for AGI, the standard deduction or itemized deduction, and other deductions. So that's the difference between the two, is that you have to take deductions from gross income in reaching taxable income. Now when it comes to the tax world, gross income is important, obviously, but it's really not the most important term. Like I said before, adjusted gross income is much, much more important, so don't worry about this one too much. So this video recapped parts 1 to 10 of the series. I hope you learned something from it, and thanks everybody for watching.